Yesterday, we got two big pieces of economic data that I want you to be aware of. First, Home Depot came out and said that they're preparing for an economic slowdown because they're predicting slower sales for the rest of 2024, even slower than what they originally expected. Secondly, we got new inflation data, which says that producer inflation, the inflation that businesses feel, came in slower than expected, and investors heard both pieces of information. They heard the slower inflation data and the economic concerns by Home Depot, and the markets rallied. The Nasdaq saw its best 5 days in all of 2024 because investors are hoping that the slower economic data and the slower inflation data will mean that the Federal Reserve Bank will start cutting interest rates more aggressively. They're hoping that it might mean that the Federal Reserve Bank will continue stimulating and pumping money into the economy, and they're hoping that this will stimulate investments to keep the stock market roaring. Now, what I want to do today is go over a few things. Number one, I want to go over what's going on with inflation, the PPI data, and what's coming with CPI, which is something we're going to be getting today. Then I want to go over what's going on with the economy, especially after what Home Depot said. And third, and most importantly, I want to go over what this means for you, how you can find the opportunity, and how you can build wealth. So make sure you stick with me until number three. So let me start by talking about number one, what's going on with inflation. But a quick reminder that today and tomorrow, I'm hosting our biggest investment workshop of the year. It's my investor summit. It's a free workshop, it's a live workshop, and it's a virtual workshop. I'm gonna be going over number one, how our money has changed, not just over the last 5 decades, but also over the last 5 years. And then I'm going to be going over how you can find investment opportunities, how you can build wealth, and how you can find the financial trends during a time where interest rates are still high, during a time where inflation is still high, and during a time where we're seeing an economic slowdown. How do you find the opportunities? It's a free workshop. I would love for you to join. Just make sure you register. I got some time tonight, and I got another workshop tomorrow morning. If you'd like to join, all you got to do is click the link down in the description below to register for free. Now, starting with the inflation data, we got PPI numbers that came in lower than expected. PPI is the producer inflation. This is the inflation that businesses feel. Now, the reason why you want to pay attention to this, even if you don't own a business, is because if businesses are facing higher raw material costs, it's a higher cost to produce a product. And if businesses have to pay more money, well, that trickles down to the consumer. So the reason why economists and forecasters and investors pay attention to the PPI is because it can give you some indication as to what's coming. And the CPI, which is the consumer inflation numbers. Consumer inflation is the price that you pay when you go to the grocery store. PPI is the price that business owners pay to get the raw materials. So when we got this PPI number that came in lower than expected, you have a lot of people that are saying, maybe there's some indication that CPI may come in low, and maybe it'll stay low in the future. And if that happens, maybe that will incentivize the Federal Reserve Bank to cut interest rates even more aggressively, which could stimulate more spending, which could stimulate more growth, which could stimulate more investment, which can boost my stock portfolio. That's what investors took it as. Now, I want you to take this with a grain of salt. And the reason why I want you to take it with a grain of salt is because there are many factors that can stimulate inflation one way or the other. One thing that we've been seeing recently is that as more and more people are anticipating this Federal Reserve Bank interest rate cut coming sometime soon, we've already seen interest rates start to fall, including mortgage rates. And as mortgage rates have begun to fall, refinancing rates have begun to boom. Week over week, we've seen almost a 20% growth in refinancing applications. If that continues, people are pulling cash out of their homes, people will have more money to spend. Now, part of the reason why we've been seeing all this slowdown in spending, slowdown in economic growth, is because people are running out of money. They're tapped out. They've maxed out their credit cards. They're getting behind on the car payment. They're getting behind on their credit card payment, and people can't afford the higher costs. But if people can find this newfound money, I'm saying it in quotes because it's not really money, it's debt. But if people find this newfound spending ability because they pull cash out of their homes, because interest rates begin to fall, well, then that could create a new spending boom, which can boost spending and can also boost inflation. But that's something you're going to want to keep your eye on. And of course, we'll be keeping you updated here and on market briefs. And remember that later today, we're going to get a CPI report covering what's going on with consumer inflation numbers. I'll be keeping you posted here and on market briefs, which is my free financial newsletter as well. This brings me to the second part of this video that you want to pay attention to, which is what's going on with the economy. Because Home Depot put out their earnings statement yesterday, and their CEO essentially said that they're predicting slower sales for the rest of the year. Originally, they thought sales were going to fall by around 1% or less than 1% for the rest of 2024. Now they're predicting sales to fall in their own stores between 3 to 4% between now and the end of 2024, which is a pretty significant increase. And this is where the CEO said that, quote, during the quarter, higher interest rates and greater macroeconomic uncertainty pressured consumer demand more broadly, resulting in weaker spend across home improvement projects. Essentially, what the CEO of Home Depot was saying, and the CFO, is that you have a lot of people in America that are getting pressured by the inflation, by the slower economy, and by the higher interest rates. And because of all these things, many people are deferring their home improvement projects, so they're not shopping at Home Depot. And because a lot of people are deferring their home improvement projects, this is where Home Depot is saying, well, a lot of people are putting a lot of weight on how the economy is going to be booming when interest rates get cut. Let me read you directly a quote from the CFO. What he said was, quote, we're navigating an economic environment that is leading to a greater consumer uncertainty and a deferral mindset. Everyone's expecting interest rates to fall, and the customer is set to defer those projects until interest rates fall. So what Home Depot is saying is that a lot of people are facing this pain from the economy. What is that pain? Interest rates, inflation, slowing economic growth, slowing wage growth, harder time finding a job. And because of that, a lot of people are saying, you know what, we're gonna put a hold on rebuilding our kitchen. We're gonna put a hold on remodeling our bathroom. And even construction teams that buy their stuff from Home Depot said the same thing, that people are deferring their home improvement projects. And because they're deferring their home improvement projects, this is where Home Depot is saying, well, a lot of people are putting this big weight on increasing spending when interest rates get cut, but they have some concerns about that because they feel that there's going to be more uncertainty ahead, even as interest rates get cut. So this is where you want to pay attention to this, because when people start to feel more pain in the economy, when people start to run tight on their money, one of the things that they cut back on, one of the first things, is home improvement projects. You say, you know what, we're going to save some more money before we remodel the kitchen. We're going to put a pause on changing the bathroom, on changing the tiles, on changing the flooring, on painting the walls. And that can kind of show you the impact that consumers are facing right now. Now, the reason why this is important is because I want you to understand now how you can find the opportunities to build wealth. And this is where I'm going to go back to the basics first. The very first thing you got to do, you need to build a savings cushion, an emergency cushion for you. I don't care where you are in your financial journey. If you don't have a savings cushion, don't worry about investing your money. Don't worry about trying to get a different job. Build a savings cushion first. That's the first thing you got to do. Once you build a little bit of a savings cushion, the next thing you want to focus on is getting out of high interest debts. These are things like credit card debts. And the reason why I'm emphasizing this is because over the last few days and week, we got a number of reports saying that, number one, credit card delinquencies are rising. Number two, credit card debt levels are rising. We broke a new record for total credit card debt in America, and we're seeing delinquency levels of credit card debts rising as well. And this is where it's especially important for you to get financially smart and get out of that credit card debt, because that credit card debt is skinning you alive financially. It is keeping your credit card company rich, but it's keeping you broke. So once you save a little bit of money, once you get out of credit card debt, this is where now you want to start financing and investing your money into the markets. When I say financing, I mean financing your investments. This is where you want to start systemizing your money, where you're always saving some money, always investing some money, and then you spend whatever's left. The difference between wealthy people and everybody else is that wealthy people invest their money first, and then they spend whatever's left. The majority of people spend their money first, and then they invest whatever's left. And what we've been seeing happen is that means they're spending their money, then using credit cards, then using buy now, pay later, or as I like to call it, broke now, broke later, and then you have no money left to save. You have no money left to invest. The average American today has less than $1,000 in their savings account. But if you look at inflation, what you'll see is that the prices of everything are more expensive. So if you face any sort of financial hardship, if your tire pops, if your window breaks, if your kid gets sick, if your wife says that she wants to go to Cancun, you don't got the money for it. And yes, your wife wanting to go to Cancun can be an emergency, especially depending on how you've been as a husband. So now, if you got to pay for that and you don't have the money for it, what do? Well, what we've been seeing, and I made a video on this a couple weeks ago, is we're seeing more and more people turn to credit cards to finance things like vacations. Gen Z and millennials are very active at this, where they're much more likely to finance vacations and this sort of fun spend because YOLO, you only live once. But this is where I want to emphasize, if you do that, you are going to put shackles on yourself, because now not only are you going to have to work to pay that money back, but you're going to have to pay it back plus 15, 20, 25, 28% interest. If you could get those types of returns on your investments, you would be a multi-millionaire. If not a multi-millionaire, a deca-millionaire. Because those are the types of returns that keep them rich and they keep you in debt for the rest of your life. So avoid that. Be financially smart and build a system. A simple system that you can follow is something like a 75-15-10 plan, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend, 15 cents is the minimum that you're investing, 10 cents is the minimum that you're saving. When you do that, you're always paying yourself first. And by paying yourself first, I mean that you're investing your money and you're saving your money before you spend all of your money. Now you have a system for your money, and this is where you can get a little bit deeper into how do you invest your money. Now there's a lot of different ways that you can invest your money. You can invest your money in stocks, you can invest your money in real estate, you can invest your money to pay down your debt, you can invest your money in your education, you can invest your money to build a business. There's a lot of ways that you can invest, but this is where you have to know your strategy, you have to know your goals, and then you have to be able to execute on that. On today's Investor Summit, what we're going to be talking about is how you can identify financial trends so you can find investment opportunities in things like the stock market. How can you find new trends where the money is going, that way you can invest your money into that trend, that way you can see the big growth, because you want to be investing your money where the money is going, not where the money is leaving out of. This is what your financial education is all about. Then when you identify some trends, some things that you want to invest in, the next thing that you want to look at is your financial education and actually analyzing the investment. You might find a new trend that you like, that you want to invest in, whatever that trend might be. Now, when you find that trend, you might find a number of different investment opportunities. Maybe it's real estate. Maybe it's a number of different stocks. The next question is, how do you analyze that investment? If you're investing in stocks, how do you read the financial statements? What is a cash flow statement? What's an income statement? What does your balance sheet look like? How do you read these statements, and how do you value a company? Because when you're now going out and investing in this thing, you don't want to overpay. So how do you analyze the investment? How do you know if you're overpaying or underpaying? How do you find an undervalued investment? See, it's all layers. And the thing that I want to caution you here is, as I talk about this, the comments that I get are people saying, well, Jaspreet, I don't know how to do all that. It's overwhelming, so I don't know what to do when I don't start. But this is where I want to remind you that building wealth and investing your money is like getting healthy. You can go down the rabbit hole if you're trying to get healthy and try to find the perfect diet and the perfect exercise. But the most basic way to start is to put down the donuts, put down the Twinkies, put down the ho-hos, and get on a treadmill. Once you do that, now you can start to optimize your diet. What are the things you should be eating? What are the things you shouldn't be eating? Once you do that, now you can optimize your exercise. How much cardio should you be doing? How much weightlifting should you be doing? How much resistance training should you be doing? You optimize after you get started. It's the same thing with your money. Instead of trying to pick the perfect investment and have the perfect investment strategy and have all the perfect vehicles, the reason why most people fail isn't because they picked the wrong investment, it's because they don't start. And so what you got to do is just get started. Start by not spending all of your money, and then start putting some money in the markets. I mean, you can just put your money into something like the S&P 500, something like the total stock market. There are funds that give you exposure to the total stock market. There are funds that give you exposure to the S&P 500, which is a group of the 500 largest companies in the stock market. There are funds that give you exposure to the NASDAQ. There are funds that give you exposure to the Dow Jones. There are funds that give you exposure to real estate. There are funds that give you exposure to healthcare. There are funds that give you exposure to AI. There are funds that give you exposure to Indian companies. There are funds that give you exposure to Chinese companies. I mean, there are funds for anything that you can imagine. Now, I gotta give you a disclaimer because I'm just a random guy on YouTube. I am not a financial advisor. Everything that I talk about is from my own experiences and my own mistakes. You gotta do your own due diligence and never blindly trust a random guy on YouTube, but this is where you wanna do your own research and start digging into what it is that you want to invest in. The simplest way to start is just to invest your money into the stock market. And when I say invest your money into the stock market, I don't mean going out and buying the Amazon stock or the Tesla stock or the Reddit stock. I mean buying a piece of the stock market. There are funds out there. Again, I'm not telling you what to invest in. I'm giving you an example. VTI. That is an ETF, which is a fund that gives you exposure to the total stock market. So if you buy one share of VTI, you're buying a piece of the United States stock market. There are funds that give you exposure to the S&P 500. Again, not telling you what to invest in. This is an example. SPY. You buy one share of that fund, you're buying a piece of the 500 largest companies in the stock market. That's called the S&P 500. This is the simplest way to start. And you can automate that process. Once you start, you just set up a system. Every week, you're just investing a little bit of money into these funds, and now you're just investing your money into the markets. Now you're getting started. Then after you do that, you can say, you know what, Jaspreet? I like this idea of just investing in the markets. That's easy for me. I don't got to think about it. I don't got to worry about it. I don't got to stress about it. It's on autopilot. That's fine. Maybe you say, you know what, Jaspreet? I want to get a little bit more sophisticated. I want to invest in innovation funds. I want to invest in dividend funds. I want to invest in emerging market funds. Cool, you can do that too. Maybe you'll say, you know what, Jaspreet, I want to get even more sophisticated. I want to start analyzing companies. I want to start researching companies. I want to start understanding the fundamentals of companies and finding good companies to invest in. Cool, now you can do that too. But it all starts with you getting started. And you don't have to stick with just one thing. I have a passive strategy and an active strategy. My passive strategy is me investing my money into funds, primarily for dividends because I like cash flow. That's just the way that I operate. That happens every Wednesday. Why Wednesday? Because it's in the middle of the week. There's no other reason. Every Wednesday, money is invested into my portfolio of funds. It happens automatically, and this happens no matter what. This is my automated system. It's my passive system. I also have an active investing system, which is that now every time I get paid, some money goes into a separate bank account and it's sitting there, waiting to be invested. Now I'm researching companies. I'm researching real estate. I'm researching startups to invest in. I'm researching investment opportunities that I believe will be more valuable in the future. This takes more work, it's more active, but it's a different game. You have to decide what is your game that you want to play, but it all starts with you taking one step. You gotta crawl before you can walk, you gotta walk before you can run. Start with $1, $10, $100, $1,000. I don't care, just get started. Don't try to time the market, just get started. Dip your toes in the water. Then as you learn, you can invest more, and then you can do more. Remember what Warren Buffett says, time in the market beats time in the market. And the second thing that he says is be fearful when others are greedy, be greedy when others are fearful. When you see markets go down, especially the first time as you're a newer investor, people tend to panic, they freak out, and they have no idea what to do because now all of a sudden you thought you were making money and now your stock market portfolio is in the red and you're down 20%. Instead of using that as a time to panic, use that as an opportunity to buy more stocks or buy more investments at a discounted price because market downturns create more millionaires because they allow the financially savvy to go out, buy more of those investments at a good price. This is where I want you to work on being financially prepared. I want you to work on your financial education, and I want you to understand the financial trends. That's where you build wealth, when you understand the intersection of these three things. And with that, I'll see you on my live investor workshop, or I'll see you on YouTube tomorrow.